into the FOMC statement. There's only 8 of these meetings a year. We are also this week inside of the VIX's expiration. This is the last day, the close of today for the March contract. We're going to be going into April. We're also expiring the quarterly contracts, the March contracts of the indices, and then going into June. And then there's also an options expiration. Now, that is a lot going on in a week. And one of the reasons that we see this kind of lack of participation during the trading day is for those reasons. And they have always been this way for years and years and years. It has been relatively slow leading up to these FOMC statements. Not necessarily in the pre-market or after hours, but during the trading day. What you're looking at right now is the Fed Fund futures, and we're currently at a 41% probability for a cut in December of 2026. Remember that 2 weeks ago, that was in June of this year. At the end of last week, we had fallen all the way to June, and so it's come about halfway back. It's fascinating. I find this absolutely fascinating that if you were to draw a 50% retracement, from the March to December where we were, March to June where we were, that we have come halfway back. I find those types of phenomenon, absolutely amazing. And interestingly, and this is why we pay so close attention to the Fed Fund futures and in relation to the indices. If you put a chart on the Fed Fund futures, it went from June to December, and we rose from Friday. And why we're keeping track, why we're making these mental notes of, it's 41%. If it starts to move into later on in 2026, what happens? We roll over here. If the cut keeps getting pulled forward into the future, what happens? We rally. And so we really have more than just banking the dollar and the VIX as a leading indicator. We have, of course, our own unique price action and gap fill statistics, but we also have the direction of the Fed Fund futures. What is currently creating the direction of the Fed Fund futures? And the answer to that question is crude oil. Crude oil is inside of a environment, and we have been here since the beginning of the Iran war, where when crude oil was falling, the indices rally. When crude oil rises, the indices sell off. When crude oil falls, the indices rally. Why is that? Because when crude oil is increasing, getting more expensive, the perception is that the Federal Reserve will have to push their rate cut out further into the future, and the indices go down. And then when the crude oil goes down, again, there's a cut that's being pulled into the future, the indices go up. And so we're in this environment, and it's very easy to just say, well, crude oil down, indices up. We really need to be cautious of that because this relationship is unusual. The normal relationship is with Fed Fund futures and indices. That's constant. But right now, the crude oil chart is having a very dramatic effect on the Fed Fund futures. So the reason I spend a lot of time explaining that relationship is because this stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.